Stocks falling Thursday as investors flee risk and drive Treasury bond prices higher. Well, let's get inside the markets with Art Hogan. He's Chief Market Strategist at National Securities, joining me today from Nantucket, Massachusetts. Welcome back, Art, and good afternoon.
Good afternoon. Thanks so much for having me today.
Thanks for being with us, Art, as always. Art, what's behind the sudden change in market sentiment that we saw this morning?
What's interesting is what we've really seen is a much more abrupt reaction in the yield on the 10-year over the course of the last week or so. And that's finally bleeding into equity markets today. So I think we have to step back and say, well, why would yields be down if we think the Fed's going to tighten and remove some policy stimulus sooner than we had thought 2 weeks ago? And what is it that has shifted? And what's really happening in real time is that there's a transition going on from a fear of inflation to a fear of growth peaking out. And some of that fear of growth peaking out comes from some of the data we've seen in the economic data stream. The ISM services was a bit light. We're concerned that some of the shutdowns that we're seeing, whether it's in Japan with the Olympics not allowing spectators, or some of the Delta variant exploding in parts of the Eurozone and India. So I think the muscle memory of what happens when we get a flare-up in coronavirus to economic activity is starting to get people saying, hey, at all-time highs, why don't we pull back a little bit of risk exposure and get into the safety trade for a period of time. All at the same time, remember that the yield on the U.S. 10-year, and this even at the 1.25 level, is much better than a lot of the other global 10-years. So you see Japan as a net buyer of U.S. Treasuries in the second quarter. That's been driving demand. I think the same thing is true across most of the Eurozone. So you've got foreign demand for our 10-year. You've got some mild concerns that growth may be starting to peak. I don't think that's the case, but it's part of the narrative. And I think that you combine all that together on a slow holiday shortened week, and you can get exaggerated moves in both equities and in treasuries.
Well, Art, do you see this possibly as a pivot point for the markets, a warning sign issued by the bond market?
Well, I don't think it's any more of a warning sign than it was back in March when we ticked at 1.75 on the yield of the 10-year. You'll remember back then we were concerned about rampant inflation and how that was going to slow the economy down and how bad that would be. And that was probably an overshoot. I think at 1.25 we're overshooting in the other direction. I think as we start to get earnings for the second quarter kicking off next week, and we start to continue to look at the economic data stream, we'll likely come back down and be somewhere between 1.45 and 1.55 on the yield. Right now, we're in that period where it's more technical and it's more of a momentum trade in treasuries. So I think that'll find a bottom. It may have found a bottom today. We're starting to tick up closer to 1.30. I think that's a good sign. But what had happened in the last 5 weeks is that growth trade, that plowing into technology stocks, really got extended. And when we look at the relative strength of the RSI of both the Nasdaq Composite and the Nasdaq 100, they were actually showing readings of being overbought after 5 weeks of constant sponsorship. The flip side of that is if you looked at the financials, the industrials, and the materials, they all are showing readings of being oversold. That's usually when we get the pivot, when that rotation starts to reverse itself a little bit. And I think we'll slowly start to see that happen next week as well. The exact same thing happened back in Labor Day weekend of last summer, where the technology trade had just gotten extended. Everything was throwing off overbought readings, and the cyclicals had been oversold. And I think we're going to start to rotate back into that trade as we enter earnings season.
So I guess what you're saying is a reversal of the rotation. Well, Art, I wanted to ask you then, what does it tell you that tech stocks are not rallying on these lower yields today?
Such a great question. And the lower yields are such a conundrum in and of themselves. But to your point, typically when the yield on the 10-year comes down, that's seen as a benefit to that long duration technology trade. That multiple that you use to discount back to present value comes down, so you can actually ascribe a higher multiple to technology stocks. That was working for a period of time, and it certainly, for most of the 50 basis point drop that we've seen in the yield on the 10-year since the peak in March has really been part of that driver back into tech. But I think that even that runs out of steam if, in fact, people are looking at this 10-year and saying, is this about peak growth or is this really about technicals in the treasury market? And I think it's more of the latter. So I think today was much more of a risk off day. One of the first days we've seen all of the sectors leaking valuation, and as opposed to saying, okay, we're getting out of technology and getting into defensives, or we're getting out of tech and getting into cyclical. We're getting out of everything. At least it was this morning.
Okay, well, thanks a lot for demystifying all this for us, Art. Our
Thank you.
thanks to Art Hogan of National Securities. I'm Fred Katayama in New York. This is Reuters.